I'm Susan Post. I'm part of the Speakers Committee of Chevy Chase at Home. So I'm going to be kind of moderating today. As you may know, Chevy Chase at Home engages our community in social and educational programming, both in person and virtually. We also provide volunteer services to older adults who need assistance remaining in their homes, including rides, errands, tech support, household assistance, and friendly visits. So our speaker for today is Alex Seleznev, an old professional acquaintance of ours who specializes in creating tax-efficient financial plans for people who are thinking about transitioning into or already in retirement. Alex and his firm, Capital Square Financial, also serve as fiduciaries and currently manage $127 million in assets for 62 families across 9 states. Alex's unique Fortress financial plan approach helps his clients feel confident about their finances, even in times of market turbulence, and gives them peace of mind knowing their retirement is secure. So without further ado, I'm going to let Alex take it from here.
Thank you very much, Susan. I appreciate the introduction. Talking about market turbulence, and we'll have a couple of slides on that. I mean, chances are we are going to experience quite a bit of it, which has been the case over the past number of weeks. And of course, hello everyone, and thank you for joining us today. I hope everyone is staying warm. I don't know what you think about this winter, but it kind of overstayed its welcome in my opinion. As much as, I have 2 boys, as much as we enjoy a little bit of snow every so often, it's just been, too cold over the past couple of months. So in terms of our seminar today, and I'll tell you, this is a modified version of one of my perhaps more popular seminars that focuses on pre and post retirement issues. This particular seminar will focus essentially entirely on post-retirement issues. I was thinking about how much time to spend on each slides and on each of the slides and on each topic. And given the number of questions that was submitted to us prior to the seminar, I actually counted 12 of them, and perhaps we'll have even more as we keep talking about everything. I'll try to cover everything as quickly as possible without necessarily going into too much detail. But of course, if you have any questions, please, put them in the chat box and we'll address them at the end of the seminar.
Well, Alex, let's have people put them in the chat. And I don't want to keep interrupting you. So unless there's something that needs immediate attention, we'll address questions in the latter part of the program, okay?
I'm in agreement with that approach, Susan. That tends to work best.
Yeah.
So in terms of the topics for our discussion today, we'll start with, some of the top estate planning considerations and gifting strategies. And at least in terms of our clients, in terms of our meetings, we tend to discuss those things more or less at the same time. One of the top questions I get from some of our new clients or even some of our existing clients, should I stay at home as long as possible in many cases in terms of my overall retirement plan, or should I consider transitioning to one of the retirement communities? And frankly, that by itself can be a seminar, but we'll try to cover as much as possible in 3 or 4 slides essentially. I'll touch on how to create a retirement specific plan, and this is really not meant to be an investment oriented seminar. So again, we're just going to touch on the basics here, and I do expect to spend probably 10, 15, if not more minutes on the questions that again came from the participants. I have them here and I included them on the slides, and any other questions as well. So with that, we'll start with the estate planning piece. Again, some of the top considerations for you to keep in mind. So in terms of how we would normally approach this, one of the questions, of course, our clients ask us, well, what documents should I have in place in terms of making sure that my estate plan is in order. So at this stage in the game, I'm just going to make a blanket statement and say that everyone should have an updated will in place. And as basic as it may sound to perhaps some or even many of you, I can tell you that rather frequently we work with new clients, their late 60s, early 70s. And then you ask them, well, when was the last time you actually looked at your will? And one of the typical responses, well, that was 20, 30, 40 years ago when I first got married, when I had my first child. So really, this is a good time to update it. And again, we'll talk about how frequently you should do that, but it's important to do that. Perhaps for those who are less familiar, and it's one of the most basic estate planning documents when you essentially outline your wishes. That is what it's all about. You can essentially draft it, well, I want to say whichever way you want, but you can customize it depending on your personal preferences. And the bottom line is so that the state, upon your death, is not essentially making those decisions for you, which in many cases, I'm going to say is not likely to be to your advantage. Now, one of the most common follow-up questions I get, and actually specifically from those of my clients who are single, does applies to families, but specifically to my single clients, should I also have a revocable or living trust in place, right? So that really depends on your circumstances. I'm certainly not the one, and I happen to work with some estate planning attorneys who suggest it as a must, essentially. I don't think it's a must, but it's a consideration. So it will likely come with an additional cost to you in terms of creating the documents and making sure that everything is done properly. But in terms of the benefits, well, perhaps one of the top benefits is the fact that any assets, and that's important, any assets that you retitle into the trust avoid probate. We'll talk about some of the most common issues when it comes to estate planning. That is actually one of them. When people create those documents, spend a lot of time and money, and then they forget to retitle their accounts. The other reason, which perhaps people don't necessarily think about that much, that of course depends on the structure of your assets, but it's particularly important for those who are business owners, is privacy. So keep in mind, probate is a public process. So when you open a new estate, essentially, usually you have 6 months for people in general to essentially make their claims, and who knows what that would look like, especially if there are any intra-family issues that do tend to happen every so often. So keeping it private can be rather beneficial for many people. The third reason, sometimes it's perhaps even more important one, is the fact that when you work on creating a living or revocable trust, you would have to, essentially designate a trustee or trustees would be responsible for handling your affairs, including when you're incapacitated. I'll tell you, in my line of work, the vast majority of my clients are, let's just say, in retirement, and rather frequently I do deal with their trustees. So it's important that everything is in place from that perspective. Now, you can, in some sense, replace that part. Perhaps that's not the best way of saying it, but that's how I'll describe it, by having a power of attorney, both financial and health, POA essentially. And again, if you decide to take the will approach, you would most likely want to have those documents as well, and they're usually prepared as a package. So if your son, your daughter, or anyone else is your financial POA, they would be able to communicate, let's say, with someone like myself on your behalf to initiate transfers, to make payments, do a variety of different things. Word of warning here, a typical or a general POA, at least that's my experience, is not going to work for most, or at least many financial institutions. Most of them require that you complete their own paperwork. As an example, we work with Schwab Institutional, and anytime again we start dealing with the POA or trustee on a regular basis, there's a form you can complete. It doesn't take long, and it can be completed electronically, so that that person can reach out directly to Schwab, not through Alex, but directly to Schwab, to initiate, again, transfers, payments, and access tax documents and all those things. Now, one of the, I'm going to say, popular tools, I'll describe it as such, is to retitle usually your brokerage account. This predominantly applies to taxable accounts or individual accounts into a TOD or POD account. And that stands for transfer on death or paid on death. And that's a good way to transfer assets and avoid probate to essentially the next generation, perhaps your children, or can be anyone else. Usually, again, I'm comfortable with that approach when we deal with, I'm going to say, relatively small sums of money, and I'll let you decide what that means in your context. Let's say we're talking about final expenses or things of that nature. And just to make my point, let's say you have $1 million brokerage account, and you want to retitle it into a POA, or I'm sorry, TOD or POD to your son. Now, your son will receive the money, usually within 1 to 2 weeks. It can be done rather quickly. There's going to be 100% step up in basis, but there will be no other protection in place for your son. That is, again, one of the biggest benefits of having a trust in place, meaning that if someone inherits your assets in the form of a trust, there is a certain level of protection against creditors, of course, bad decisions, divorces. I happen to deal with that relatively frequently. So when the assets are in a trust, it gives you a lot of protection. One of the things I'm not including here, but I'll just make this statement. I'm going to say that applies 95% of the time. Creating a revocable trust does not reduce your tax liability. So if someone is telling you that you should spend thousands of dollars to somehow save yourself some taxes, that is just not going to happen. That is not the primary reason why you would want to have this in place. So when should you revisit your estate plan? Well, the rule of thumb is every 7 years. And I happen to work with several estate planners. They'll most likely say every 3 to 4 years, just to make sure you stay on top of it. Again, you review, make sure it matches your situation, your preferences, and that's that. So that's up to you. The idea of reviewing your beneficiary designations, which was actually one of the questions that was submitted to us prior to the seminar, at least for our clients, we review them annually. Once you have everything in place, and I'll talk about that separately, it takes like 5 minutes to do it, but it can prevent, I'm going to say, major misunderstandings. And I'm using, gentle words here, but that's important. Of course, if you ever experience a major event, not to go in detail here, but if you ever get widowed or divorced, of course, that would be a trigger event for you to revisit not just your estate plan, but most likely your financial plan as well. If you change your charitable intent, I'll actually make a perfect example here. One of my clients who's been in retirement now for a couple of years, she feels very comfortable, and she recently visited the university she graduated from like 50 years ago. So now she wants to leave 10% of her estate to the university. Or of course, the documents need to be updated to reflect that. The bottom point here is somewhat outdated here. I wanted to remove it, but then I thought I'll just quickly describe it. So when the Secure Act version 1 and then version 2 came out, that certainly triggered pretty much a need to review, and in many cases revisit, many people's estate plans. One of the major parts of that, and again, that was one of the questions, if someone who is a non-spouse inherits your IRA account, the traditional IRA account, they now have to distribute the funds over a 10-year period. Prior to that, used to be over that person's lifetime, and if it's a younger beneficiary in her 30s or 40s, of course, that's a major tax benefit. That is no longer the case. So again, I'm not going to go in the weeds here, but what some of my clients decided to do, they actually made the charitable organizations the beneficiaries of their IRA accounts, because it doesn't matter to them, how they receive the money. And in terms of their taxable accounts, it's now their children, because there's going to be 100% step up in basis. So if they decide to sell your highly appreciated stocks, they will not pay anything. This is not any kind of advice, of course. All of this depends on your personal circumstances, but that was, again, one of those major trigger points. What are some of the top mistakes to avoid? Procrastination. And again, I'm sorry, but that is one of the top mistakes. No one wants to think about that. I don't have very many clients who are, excited about talking about their estate plans. Some are, comfortable with it, but people procrastinate. And every so often, I mean, not to again get in the weeds here, but I had to go to someone's house to actually witness him signing the documents. He was on his deathbed, essentially. You do not want to get to that point. Beneficiary designations. Again, when you experience those events, it's important to update them. Let's say you have multiple children, as an example. Let's say their situation is different and over time it changed. The most typical is, of course, to keep everyone, this equal percentage, but it doesn't have to be that way. So again, periodically updating the beneficiaries is important. The third point I'm inclined to say is not going to be all that relevant for this group. Again, I'll quickly say that. If you have any kind of life insurance, most people don't necessarily think of it as part of their net worth because they're just making premiums. But keep in mind, like in Maryland, as an example, the exemption is $5 million, as perhaps many of you know. So if the value of your assets, including your house and everything else, is, let's say, $4.5 million, and you also have a $1 million life insurance policy, well, keep in mind, if you die and it actually pays to your estate, you will now have a taxable estate. And in Maryland, by the way, it's 16% over 5 million. I mean, there are different brackets, but it's 16%. And then the fourth mistake, which is perhaps in some sense, the worst one, is when people, again, spend the time and money to prepare the documents. They analyze everything. Everything looks great. They execute the documents, and they forget to retitle their accounts into the trust. And it's pointless. Something happens, person, dies, people look at their documents and everything is in place, but the accounts are still under his or her own name, part of probate, essentially. And I've been involved in situations like that, unfortunately. All right, so switching gears here a little bit, even though this is, again, usually part of the same conversation. So gifting, and we'll talk about both gifting to perhaps your family members and to different charities. So I'll start with the basics here. So cash gifts and donations. Usually it's very simple, right? So anytime we're talking about small amounts to different charities, or let's say I have multiple grandchildren, and you just want to give them some cash for holidays, usually I wouldn't bother with any kind of planning. You just give them cash, you keep track of it, and then you send the spreadsheet or some other document to your CPA. Now, in terms of giving perhaps larger gifts, and again, I will leave it up to you what larger means in your context. In many cases, can be very beneficial tax-wise, not just for you, but then for the entire family, to gift appreciated stock. And I will describe an example in just a moment. Keep in mind, again, just to keep everyone updated, the annual gift tax exemption in 2025 is now $19,000. It's per person. So if we have 2 grandparents and let's say 2 children, you would essentially multiply it by 4. So keep that in mind. One other, not so much a mistake, but a misunderstanding. If you ever go above 19,000, let's say you decided to gift someone $30,000, in most cases, that's perfectly fine. The only requirement is for you to file a gift tax return, in your lifetime exclusion, which is again 5 million in Maryland at this point, and almost 14 million in the federal level, would be reduced by the amount above 19,000. So again, if someone wants to buy a home and you want to make a larger gift, don't feel like you're limited by the annual exclusion. So stock gifts. Again, what are some of the reasons why you would want to do that? Well, again, I believe in a couple of weeks, I'll be talking with grandson of one of my clients who finally reached the age of majority, so we can actually create a brokerage account for him. So he will receive some cash, actually, in this case, but perhaps it's going to be appreciated stock. And the idea is for him to start getting educated, essentially, on how the markets work. That is, at least in my experience, one of the biggest issues with, gifting large amounts of cash. You don't know what your grandchildren are going to do with it. Perhaps they're just going to go ahead and spend it, and that's fine, but perhaps that's not your intent. When you give them the actual stock, well, hopefully they'll keep the positions and perhaps even add to it. Now, in some cases, there are also tax benefits. So let's say we have Judy here, who's a grandmother. She's in a 25% tax bracket. Doesn't matter how we determine that. So let's say she sells $1,000 worth of appreciated stock. And let's say she had that stock for a long time, she bought it 30 years ago. The capital gain in this case would be $700. She would have to pay taxes, 25%, so $175 goes to taxes. So the actual gift in this case is only $825. Of course, keep in mind, if it's 10 times more, right, that will be 10 times more in terms of the tax liability. Now, on the other hand, we have Eric here, who's her grandson, recently graduated, still looking to get a job, essentially in a 0% tax bracket. So he receives the stock, perhaps he keeps it, perhaps he sells it, but he ends up paying no taxes. See, the power of doing this, and I was reluctant to show you, examples with large amounts. I don't want it to be perceived in any way. But if you do this with larger dollar amounts for many years, it's a great way, again, to transfer wealth to the next generation. Stock donations, again, part of the same conversation, but now, of course, we're talking about charitable organizations here. So the idea here is to think of it as a double tax benefit. That's how I like to describe it. So when we donate stock to a charity, to a qualified charity to be specific, we get a tax deduction that depends on your overall tax situation. You need to make sure that you consult your CPA or a financial advisor who understands how it works. But at the very least, you would eliminate the capital gain taxes. So let's say we have Raymond here who wants to gift $5,000 to United Way. Let's say he's in 25% tax bracket. Same situation, highly appreciated stock. If he sells the stock, he has a gain, $3,500, has to pay taxes. So the actual gift is only $4,125. So you would have to add to that. Or he can donate the entire position. All he has to do is complete some paperwork. It goes to United Way in this case. He receives a $5,000 deduction, which again depends on his overall situation, and there's no capital gain tax. Again, I don't want to go in the weeds here, but for those of you over the age of 73, it's particularly important because of Medicare premiums as an example. So when you sell too much in appreciated stock, it can impact your Medicare premiums. And in terms of your required minimum distributions, again, if you ever go in the next tax bracket, let's say from 22 to 24, perhaps not that bad, but then from 24 to 32, you have to be very careful about that. Again, we're dealing with relatively small sums here, so perhaps it's hard to see that difference. But if we start talking about larger amounts, it's entirely possible. So qualified charitable distributions, and I'm glad, again, we're talking about this in the beginning of the year because this question tends to come up at the end of the year when people deal with their required minimum distributions and everyone is essentially rushing to do this. So what are QCDs? That's how we usually refer to them. So these are direct, it's very important, direct transfer of funds from your IRA to a qualified charity. This does not work with 401k accounts, 403b accounts. It has to be your IRA, essentially, or rollover IRA. So the QCD counts toward your annual required minimum distribution. So at the age of 73, you have to take the funds out. And the goal here, so it's a rather simple, is to satisfy your charitable intent and, of course, minimize your taxes. So usually it's easier to describe it as an example. So we have John here, who's rather happy, right? Because we learned about the strategy. So John's RMD this year is $30,000 and he's in a 24% tax bracket. So he has significant charitable intent and he transfers $20,000 of his RMD to different charities. It can be any number of charities. What are his tax savings? Well, it's his marginal tax bracket. In this case, it's 24% or $4,800 plus state tax savings. So in Maryland, it's usually 8%. In DC, it's also 8% and 6% in Virginia. Again, I'm giving you relatively small amounts, but imagine if you do more than that year over year, that can save you, again, a significant amount in taxes. What are the benefits of donor advised funds, or DAFs, which is how people usually refer to them? So the idea here is to create a charitable account that is designed to actually accomplish two things: to invest the funds that you contribute, and then eventually essentially transfer those assets to the charities. The contributions that you make into the DAF are tax deductible, or I should say potentially tax deductible in the year of contribution. In most cases, you would want to do a calculation of how much you need to contribute to really minimize your taxes. And again, I personally never dealt with a situation when people donate cash. It's usually appreciated stock, so you can also eliminate any unrealized capital gains. The important part here, at least as we speak today, once you make the contribution, the funds can be distributed to the charities of your choice over essentially an unlimited number of years. They talked about capping it at some point, but that hasn't happened. So it's, unlimited number of years. So here's Marilyn here, who is also happy because she learned about the strategy. So her goal is to support her family, her favorite charity, and give them $5,000 a year. She knows for a fact she's going to do it for the next, number of years. So one of the options she has is to transfer $30,000 of appreciated stock into a DAF. She would receive a tax deduction of $30,000. Again, can be less than that depending on her circumstances. And that also eliminates any capital gains that she would have to essentially generate by selling the stock. Once that happens, she just sticks to her plan and continues to transfer $5,000 per year out of the DAF to her favorite charities. What I'm not including here on purpose, but again, the funds that remain in the DAF, they can still be invested. So over time, the total gift can actually be even higher than what she originally contributed. Okay, so taking a sip of water here. So changing gears, even though again, this tends to be part of more or less the same conversation, but usually in a different context. So the idea of staying at home, or essentially aging at home, or transitioning to one of the retirement communities. I will start by saying that, I guess goes without saying, this is a very personal decision, at least in terms of where I'm coming from as a financial planner. I tend to deal with this relatively frequently. We have this conversation with most of my clients. I'm rarely the one who raises this question. I don't necessarily feel comfortable do that. This question usually comes either from our clients, which is usually a good thing, or in some cases from their children, which becomes a bit more of a sensitive conversation. I'll start by saying, perhaps stating the obvious here, that most people prefer to stay at home for as long as possible. Again, they want to explore other options, and where we are in year 2025, specifically in the DC area, I don't know how many different communities you visited, but a lot of them are certainly not what it used to be 10, 20, or 30 years ago. I like to say that in some cases, people actually transition to live there because they offer different options, independent living, then there's some help, and then eventually transition to, let's say, a memory care unit. So a lot of places offer all three of those options. What we try to prevent, essentially, when we work with our clients, is this idea of being forced to transition to a retirement community. I have an example here. So one of my clients, she's now in her mid 80s. So she used to live in DC, very independent woman. So she went to Whole Foods, if I'm not mistaken, to do groceries. So she fell, and as you can imagine, it took her over 6 months, if I'm not mistaken, to fully recover. She was in a wheelchair, but the reality of the situation is she never truly fully recovered. So then she had to have aides come to her house. Her expenses started to build up, and essentially, within 6 months or so, she transitioned to Ashbury in this case. So she's there now. Now she seems to be enjoying it now, but frankly, that was not her choice. She was not necessarily prepared to do that. It's just that her, life circumstances essentially forced her to make that decision. In terms of sometimes even our existing clients, and I covered this in one of our newsletters, of course, people tend to feel very independent and want to remain as independent as possible. But every so often you start digging a bit deeper, start thinking about things like social isolation, which tends to come with limited mobility. So that's one of those, again, questions. Is this truly what you want? The idea of having a strong support network. Of course, that's one of the things that villages such as Chevy Chase does very well, because many people don't have that support network. One of the things I say openly, even when I talk about this with our clients, in many cases, it's really not wise to rely on your children. They may not be in this area. So how exactly would that work? And even when they're helping you, let's say you're in this situation for the next 5, 7, 10 years, well, it may very much create a burden on them. So I'm not sure if that's necessarily, again, the best support network for you. The bottom line is explore your options ahead of time. We're talking about your financial situation. We're talking about visiting different communities. As perhaps some of you know, they would be more than welcome to give you a tour. Yes, some of them are very expensive, like the one they just opened in DC, Inspire. I don't know if any of you heard about it. There are some of them that are much more manageable. There are lots of choices. In terms of the potential costs, so I've tried my best to do a little bit of research here on the internet. I'll tell you up front, I don't trust these numbers, because when I, again, work with my clients, look at the actual expenses, they tend to be much higher than the averages. But still, to share this with you, of course, if you decide to stay in your home, chances are you would need to make some adjustments to it, so it's agent friendly, how they say. And I can't really find any kind of average for you. I'll just tell you that we have clients who live in Frederick. It's a single level home, and they actually updated everything within a year, and it cost them only $75,000. So we were the ones making distributions to them. So it was a relatively manageable project. The other family there in Potomac, it's a multi-level home, so they had to add an elevator, all of those different things. It took them multiple years, and the total cost was right around $300,000. So the range can be rather wide, let's put it that way. If you ever need an aide, semi-skilled care, in other words, the average in the DC area is $22. If you ever need essentially a nurse or a nurse practitioner comes to your house to do any kind of medical procedures, it's of course going to cost you more. The average is $30 for that. And overall, again, in the DC area, on average, you're looking at over $55,000 a year. Take these numbers for what it's worth. I can tell you most of my clients who are in this situation, I would say it's a solid 6-figure plus on an annual basis. Now, one thing I wanted to cover is invisible costs, again, quote unquote, meaning that, anytime you perhaps find yourself in this situation, someone else needs to arrange for a lot of these things for you. It can be your, of course, immediate family, your children, it can be your siblings, One of the examples I use in my presentations, one of my clients, she lives in DC, a very successful woman actually, but she's originally from Chicago. So her sister, who's younger than her, had early Alzheimer's essentially. So she had to travel back and forth to arrange for the care, to see her multiple times a year. And eventually, after like 4 years of doing that, they basically sold the house and transitioned her to one of the communities. And goes without saying, like she was not paying herself to do this. She's in retirement, supposed to be enjoying her, golden years. So those, again, invisible costs should really be accounted for. Again, I don't want to go in much detail here. I'll just say that the way we would approach this, if you can envision 3 projections. Here's your current scenario. You are where you are. You're enjoying yourself. It's working for you. Let's say 5, 10 years down the road, you need some kind of assistance. What would that look like? Do you have a long-term care policy in place? How will that impact your portfolio, essentially your cash flow? And here's this 3rd scenario. It's a hypothetical, because it tends to be a sensitive topic. What happens if 10, 15 years down the road, you actually need to transition to one of the communities? How would that impact your situation? And that leads to the 3rd slide I wanted to discuss, and that was actually one of the questions from one of the participants, I believe. So actually made it into a slide. So rental versus buy-in communities. And by the way, many of them will offer these options to you. So this becomes, think of it as a combination of financial / estate planning questions. So you'll see what I mean. So one of the common options, sometimes it's 3, I've seen 4, I've seen 5, but they're usually a variation of what I'm about to discuss. So you have the monthly rentals. From our perspective, those are the easiest to analyze, and essentially it works. The way it works, you transition to one of the communities. Let's say it starts with $5,000. I'm just going to use that number. I know it can be much more than that. Each year, you're subject to inflation, of course, and many of them, they'll even report, what the potential increases would look like. From our perspective, again, in terms of doing analysis, it's pretty straightforward, because when we understand someone's housing expenses, we're essentially replacing that with the new rent at the retirement community. So this can be analyzed rather easily. The second option, which is a little bit of a hybrid, is when they say, there's going to be an entrance fee, usually a relatively significant sum, but will issue a partial refund to you if you vacate the unit, essentially, within a specific timeline. So 50 months, can be longer than that. I've seen them, 72 months. So the longer you stay there, essentially each month, the amount of potential refund goes down by like 2% or so. Now, one of the benefits of this approach is usually it comes with a lower monthly fee. And if you actually stay there beyond the decline in entrance fee period, the lower monthly fee remains in place. But again, if you essentially die within that period, your estate will receive a certain sum of money. The 3rd option is by far the most challenging one to analyze, and that's the it can be 80 to 90% refundable entrance fee. Of course, in most cases, it's payable to the residents in state. And the reason it's challenging to analyze is, well, of course, if we're talking about 700,000 to 800,000 or more in some cases in terms of the initial fee, if you happen to have that much sitting in your bank account, well, that's not a particularly challenging calculation. But what if you have to sell your house to afford the fee, right? So one of the questions, I would say, for many people in our area, you bought your house 30 years ago for 100,000. You look at the market value as of today, it's 2 million plus. Well, goes without saying, if you decide to sell, even once you account for the exemption plus any kind of improvements, chances are there's going to be a significant capital gain and capital gains tax. So we need to understand what that is. If you have a brokerage account again, that's significantly appreciated in value. If you start selling all those securities, in 1 year, that generates a significant capital gain. The worst case scenario here is when we work with clients who have large IRA accounts. Yes, as many of you know, they're fully taxable. So if you ever decide to take out, $700,000 out of your IRA, you're looking at a tax bill that would be like a 300,000 of that. So essentially, we're talking about $1 million transition. This is where you can get creative, and that's where sometimes you really need to work with an estate planning attorney who specializes in elder care. I'll tell you one of the, just as an example, the way we set it up for one of our clients. She, used to live in Bethesda, in a classic situation, as a highly appreciated house, IRA accounts, had 3 children, and the way we set it up, they essentially funded for her to stay in the retirement community, so that, well, yes, upon her death, they essentially inherit the house with 100% step up in basis. And for the time being, they were actually renting the property and generating some income. This doesn't apply probably to most people, but again, can be creative here. Okay, so again, switching gears here a little bit, talking about creating a retirement specific financial plan, which is again the specialty of Capital Squared. We refer to them as Fortress financial plans. That's one of the names I came up with just to kind of help people understand what it means. And in terms of the key issues that I would say most of our clients face, and I'm inclined to say this shouldn't be surprising to most of you. Of course, at this stage in your life, people tend to have lower risk tolerance, essentially. That's how it normally works. We have many clients who continue working in their late 60s, early 70s. They enjoy what they do. They certainly don't do it for money in many cases, but at the same time, if they lose a significant portion of their assets, it will be hard for them to replace it. They certainly want to be protected against market turbulence, and I would say that point is of particular importance given the new administration's objectives. At the same time, for many of our clients, and yes, we're talking about late 60s, early 70s, we usually run our projections at least to age 95. We actually start doing it to age 100. So protecting against the longevity risk is important too. To say it bluntly, we want to make sure that our clients do not run out of money in retirement, meaning they don't invest so conservatively that over time they run out of money. The other point, which, I understand this is subjective, but for many people, once they achieve a certain level of wealth, I'll use that word, any additional or marginal dollar may not make that such a big difference. Once you have a certain lifestyle, as long as you're able to preserve it, you don't necessarily need much more than that. And again, these are some of the key considerations of what we do. In terms of the objectives, again, the idea is to create multiple lines of defense. I don't know how many of you visited France and looked at the medieval castles. I always found them to be rather fascinating when you see like a castle in the middle of some kind of field, and the way it was set up so that sometimes a few hundred people were able to defend a large area against like thousands of invaders or barbarians. So just that concept kind of stuck in my head. This needs to be, of course, customized for each client. You cannot have a model portfolio. It's just not going to work that way. And of course, it needs to be tax efficient. So we need to accomplish all 3 goals. In terms of the background, I understand this is somewhat generic, but this describes, I would say, many of our clients. Let's say it's a single woman, limited income, no pension, average Social Security, recently retired, has above average life expectancy, which is again common for women. And let's say her projected expenses is $10,000 a month. So how would we approach this? The first line of defense would be to have enough in cash reserves to cover up to 12 months of expenses. At this point, money market accounts are good for that purpose. We're talking about 4% plus and risk-free income. And again, the goal here is to really provide for immediate cash needs. Second line of defense, which by the way, hopefully at least will partially address one of the questions that was submitted to us. We like to build bond ladders that consist of individual treasury bonds. We'll spend a bit more time here. The reason we like it is because with individual treasury bonds, we know exactly when the bond is going to mature, we know exactly how much we're paying for it, and we know exactly how much we're going to get when the bond matures. Mutual funds can be perfectly fine when the markets are doing okay. However, and this doesn't apply just to bond funds, but stock funds as well. Like if you go back to 2020, when the markets are down and a lot of shareholders are redeeming their shares, the fund essentially needs to sell the assets inside of the fund. So your performance results even inside of a conservative bond fund can be unpredictable. That was exactly our experience in March and April of 2020. Things recovered, so if you don't sell, you'll be fine. But if you actually need the money, individual treasury bonds are more secure from that perspective. At least at this point, we're talking about yields of 4.4, 4.5%. Keep in mind, again, they're particularly beneficial for Maryland residents because you don't pay any state income taxes. So if you compare a money market fund and a treasury fund or bond, you will do better with the treasury. The idea here, as I mentioned, is again to ensure no stocks need to be sold in times of market turbulence. Third line of defense, I would say perhaps the most important one, we like dividend paying stocks. At this point, you're looking at 3 to 4% on average, depending on how you want to put it together. And the objective we have, which we cannot accomplish every single time, but that's our target, is to cover as much as 100% of our clients' expenses simply from income, meaning they would not need to touch the principal. Again, I want to make it clear, we don't have this set up for every single client we have because you need to have a rather sizable portfolio for this, but there are a lot of benefits. Again, you're not touching the principal. Dividends tend to be sticky, meaning that they're usually paid by more mature companies, and they have a history of increasing those dividends year after year. So you get that inflation protection built in. Fourth line of defense, we like to overweight domestic large cap stocks, at least at this point. I don't want to go into much detail here, but this probably specifically applies if you work like with a financial planner or advisor. There's this concept of diversification, which of course we fully subscribe to. You don't put all of your eggs in one basket. Now, at a certain point, I call it a portfolio diversification with a W. That's the term I actually came up with. And if you every so often you look at someone's allocation, they have dozens of different funds, 20, 30, 40 different funds, international holdings, small caps, and everything under the sun. The question is, why do you need all of those things? I can go into much more detail on that. I will not do that today. But the bottom line is, for many people in this category specifically, you can do rather well by dealing mostly with, again, domestic large cap stocks. There are a lot of choices there. Finally, and this is again, client by client basis, the rest of the portfolio, of course, needs to be invested in growth-oriented stocks. The idea is to protect your portfolio against inflation. And perhaps eventually, one of the questions I do like to ask, or sometimes our clients bring that up, are you really investing for yourself, or is this for the next generation? So what's relatively, happens relatively frequently on our end, as our clients, progress in their retirement, we actually adjust their allocations to be more growth-oriented. It may sound counterintuitive, but again, the risk, it's when you're early in your retirement and as you transition and your portfolio continues to grow, there's usually lower risk. What's the outcome here? Of course, we want to make sure that our clients feel confident that their portfolio can endure prolonged market turbulence. Like over the past number of years, if I go back to 2020, it was certainly nice when the markets recovered in 2.5 months. but that's not how it usually works. It can take much longer for the markets to recover. Of course, we want to make sure that in terms of the actual impact, which is not so much the dollar amount of the portfolio, but the cash flow, there's no or limited impact on the lifestyle. And again, with specifically with the income-based approach or the Fortress financial plan, is the idea of sleeping well at night, knowing that your retirement is secure. Those are, again, our objectives here. And with that, we have questions. So Susan, what I will do then, I will address the questions that were submitted to us prior to the webinar. I put them actually on the slides here, but if anyone wants to ask any other questions, I'm happy to address them as well.
Okay, that's fine. Why don't you go ahead? I have one question here, saying, my husband passed and his IRA account transferred to me. Do I pay taxes now or only on withdrawal?
Only when you withdraw the money. So with when you inherit an account from your spouse, essentially it becomes your own account. So if you're 73 or older, you would have to take the funds out. If not, then you just essentially wait to age 73.
Thank you.
Okay, so what's a sensible way to check that all your legal and financial accounts have beneficiaries listed? So I'll give you 1.5 answer to this question, essentially. I've heard of an app like you can download on your phone that you can link with your different accounts, and essentially it would tell you what the beneficiaries are on your accounts. I've never used it before. I don't necessarily recommend it to any of our clients. I just know it can be done that way for those who are interested. What we normally do, again, for our clients, we put together their statement of financial condition or their net worth statement. Sure, most of you are familiar with that. And on the right of the value of the account, you list the beneficiary. So when you review it periodically, let's say annually, you keep track of your net worth, you can easily see this is, let's say, joint accounts. Obviously, your spouse is the beneficiary. This is, Mike's IRA. And let's say I'm the primary beneficiary and our children are the contingent beneficiaries. And of course, you review it. What I've done here, I copied and pasted essentially a part of our meeting agenda with some of our clients. We usually do this at the end of the year. It just feels logical to do it that way because that's when you deal with required minimum distributions, QCDs, and all of those year-end, tax planning items. So it's also a good time to check your beneficiaries. And then the second question, and that all are named as part of your legal estate. Yes, I'll give a partial answer. When I refer someone to let's say an estate planning attorney in my network, some of them, when they prepare your documents, they'll send you a summary, usually 1 to 2 pages long, which I find to be incredibly helpful because it, lists, of course, your objectives. It lists where the trustees are, beneficiaries, any specific bequests or anything else that is relevant. So that summary can be great for those purposes. If not, then in some cases, we would actually be the ones to summarize it. And again, keep track of it the same way we would keep track of it of the beneficiaries. Understanding that, of course, something like that needs to be updated periodically.
Alex, what about bank accounts? Do they need to have listed beneficiaries, POAs? How does that work?
Absolutely. So what happens is at least for many of our clients, the accounts are joint. So for as long as they're joint, you're fine. You don't necessarily need to check the beneficiary. In some cases, if you want to take, I'm going to say, a safe approach, you can retitle them into a TOD, which I find to be a sensible way of dealing with it because, again, in many cases, those accounts, they don't necessarily have such a large value. So a TOD approach can be beneficial. We can keep track of it exactly the same way.
Thank you.
No problem. Since many retirees depend heavily on fixed income investments, what is your opinion on constructing a bond ladder versus using bond mutual funds? I believe I've addressed this question. We're big proponents of using individual treasury bonds. We do use mutual funds for bonds as well, but usually on strategies that are designed to maximize income. So high yield bonds, total return bonds, unconstrained bond funds. I'll spare details here. But in terms of creating that portfolio stability, I'm inclined to say the best way to do that is, again, create a bond ladder. When should you stop rolling over your RMDs to your taxable investment account and start taking them for living? So I read this question couple of times, so I'll do my best to address it, but if somehow, some way I misunderstood the context, please let me know. So when you turn 73, right, under today's rules, you're required to take a certain portion of your IRA, 401k, 403b account now. Now, that's an IRS requirement, so that you take the funds out and you pay taxes. What you ultimately do with the money is entirely up to you. If at this stage in the game, let's say you just don't need the money for any reason, you're still working part-time, you just don't need it, essentially, what many people would do, they would simply reinvest the funds in their brokerage account. I would say that describes a good number of our clients. On the other hand, like we talk about the portfolio distribution strategy, usually when someone reaches that age of 73, their IRA accounts provide, in some cases, a bulk of their cash needs. So let's say your RMD is $50,000 a year, and you need a total of 70,000. So of course, net of taxes, it would replace more than half of your income. My short answer is, it's up to you what you want to do with your RMDs. And again, let me know if I'm missing something here. Okay. Who should you name as executor of your estate if you don't feel one of your children can manage it or lives across the country? So yeah, that's a very good question. Say probably impacts a good half of our clients. So many of them name their friends as close friends, presumably, as the executors of their estate. One thing I like to say, make sure, of course, you have this conversation with this friend of yours, making sure that he or she is comfortable with that role. And in terms of selecting this person, it doesn't have to be a highly sophisticated financial person, in my opinion. It needs to have someone who understands the basics of finance, and also someone who is detail oriented and can deal with paperwork. So that's important because it involves quite a bit of paperwork, coordinate all of this with your attorney. Now, that's usually the second choice. You would usually prefer someone who is younger than you, or perhaps you would need to update the executor periodically. I've been involved in situations when, again, people name their friends as executors, but then, God forbid, something happens to those friends and they're no longer able to serve in that role. Does the executive need to be local? No, there's no such requirement. I will just say that if someone, just to make a little bit of a dramatic example, if you live here in the Washington, D.C. area and someone else is in Washington State, in terms of travel and doing the actual work, it will likely be a little bit of an issue and also an additional expense to the executor. And by the way, in most cases, that's the most typical language in your will, where the executor can actually reimburse himself or herself for their incurred expenses. A lot of things can be done electronically this way, which is good. So perhaps 5-10 years down the road, it will become even easier. But again, keep in mind that this will likely create some issues for the executor. If an accountant or attorney, how much do they charge? The range is, again, based on my knowledge at least is rather wide, the best number I can give you is $300 per hour. So I thought about that. I looked at some of our prior engagements. I'm sure you can find someone who would do it, for less essentially. Perhaps you have a friendly, attorney who would be willing to do that for you. But if you want me to give you an average, it would be like $300 for a smaller firm. If you ever go to one of the larger firms in Bethesda or DC, it's probably going to be more than that. Okay, longer questions, but relatively short answers, I'll tell you that. If a deceased spouse makes his surviving spouse the primary beneficiary of his IRA, does the value of that IRA add to his estate for estate tax purposes, or does it not add because of the unlimited marital deduction? So essentially the person who asked this question answered his or her own question. Because of the unlimited marital deduction, it's essentially added to the estate, but then it's immediately removed because in this particular scenario, the unlimited marital deduction will apply. The second question is somewhat similar. If the deceased spouse had a joint with right of survival checking account at death with his wife, does half or none of the value of that account add to his estate for estate tax purposes? Very similar answer to that question. Since this is a checking account, the step up in value, the 50% step up in value would not apply. Just kind of to ask the third potential question here, if this is a joint brokerage account, then the survivor spouse would actually receive a 50% step up in basis on the value of the account. If a 75-year-old deceased parent leaves a traditional IRA to a healthy adult child under the 10-year rule under Secure Act 1.0, does the child have to take a distribution from the traditional IRA in years 1 through 9 after the death of the parent, or can the adult child wait and take out everything in year 10? So in July of last year, of 2024, the IRS finally came up with the clarifications, and they made it very clear if at the time of death, the original beneficiary had to claim or had to take his or her required minimum distributions, the person who inherits the account, the non-spouse beneficiary, has to continue the distributions in years 1 through 9 under his or her lifetime. The bottom line is you have to take the RMDs, and by year 10, your inherited traditional IRA needs to be fully depleted. This impacted a good number of our clients. So we were waiting because up until July of 2024, there was no such clarity. And the assumption was that you could just wait to year 10. That is no longer the case. So at this point and going forward, the RMDs need to happen essentially. What if the IRA is a Roth IRA? So no such requirement. The reason that's the case is because if you own a Roth IRA, you're not required to take any required minimum distributions, which is one of the benefits of these accounts. So if a non-spouse beneficiary or person inherits the account, he or she is not going to be subject to the RMD requirements. So the most typical strategy is to wait to year 10, essentially, invest presumably for growth, and then distribute the funds out of the Roth IRA. If someone opens a Roth IRA, can he take out the initial contribution, not the interest, at any time, at any age? Absolutely. So Roth IRA contributions are considered to be post-tax contributions. You can take them out at any time. I do not recommend this strategy. I get this question from some of my, let's say, younger clients who say, look, I'm going to make a contribution, but if I really need the money, can I, take some out? Yes, you can, but you really shouldn't, because this is such a valuable account in the long run. But the answer to that question is yes, you can do that. With that, Susan, do we have any other questions?
One is Congress making changes to IRA regulations, I think.
Also, with the new administration, anything is possible at this point. We're learning of new things, not just on a daily, but on hourly basis, essentially. I mean, I don't know, we're happy to speculate here if you want me to. One of the things that will likely happen, and I believe that's actually part of the original Secure Act, eventually they'll, change the age from 73 to 74, and then I believe to 75. That, of course, will not impact, if you're currently distributing the funds from the account. So in terms of the Roth IRA conversion specifically, that's one of the questions I get. Let's say we do all the multi-year Roth conversions, we pay all the taxes now, hoping to kind of lock that in, so then you get the tax-free growth in the long run. I mean, I'm inclined to say that those are safe, because it would be incredibly politically unpopular to essentially double tax those people. I mean, I just can't quite envision that happening. So I mean, it's hard for me to answer that question, but anything is possible. Thanks so much, everyone.
Thank you
Appreciate it.
all.